Thank you for joining us. It's countdown to the monetary policy announcement, and the Central Bank Governor Godwin Emefiele will, in a very short while, announce the decisions. In the meantime, let's look at some of the key considerations before the committee and possibly what the decision would be. I still have with me in the studio my panel of discussants, Mr. Muda Yusuf, the Director General, Lagos Chamber of Commerce and Industry, and Steve Osho, the Managing Partner at Commercial Partner Asset Management, and of course Matthew Kiniga, Senior Analyst for West African Markets at Docker Frontier, London. Right, Matt, I'm going to start with you now. All right, well, we're talking about the adjustment of the Naira. From your own perspective, what do you make of that adjustment? Well, the central bank, that's its way of responding to the oil price shock.
Yeah, so I think this is actually a very significant move in terms of the adjustment to the value of the Naira. I've been monitoring Nigeria for a number of years, following it very closely, and the central bank has made several indications that its intention in the long term was a kind of harmonization of the multiple exchange rates and some kind of foreign currency reform. So it is good to see that there is that the central bank is taking action in terms of the value of the Naira. I think it had very few options available to it, or very few alternatives, apart from allowing the Naira's value to change. And what is encouraging is to see that both the official rate and the NAFEX rate, the investors and exporters window, has also changed. So this is really it's really quite crucial for a number of reasons. And firstly, access to foreign currency. This is going to have a significant impact on access to foreign currency in the short term. We were quite concerned here at Docker Frontier that there was going to be increasing shortages of dollars as a result of the oil price crash. But this will go some way to sort of allay the fears of investors in terms of accessing currency. It also has an impact on confidence, investor confidence overall, but it also shows that the central bank is adopting quite a sort of pragmatic approach to managing the currency. What I don't expect to happen is a sort of free float of the currency. I know there's a lot of our clients at Docker Frontier ask us whether there's going to be some kind of exchange rate reform like we've seen in Angola, where the currency is much more set by free market or market forces. I fully expect the central bank to maintain a sort of fairly stable currency, it's good for planning, it's good for investors to an extent. But this reform of the exchange rate is quite good for investor sentiment. I would also say that it's also very important for the competitiveness of Nigeria's exports. So although oil prices have fallen, it does mean that in Naira terms, the government will be earning more as a result of the adjustment of the Naira from oil exports. But also things like agricultural products and other domestically produced products will be more competitive internationally. So by and large, I think it's a good move. One of the concerns is obviously it could push up the price of imports a bit more, and so that would have an impact on inflation. So that's something that we will be watching.
All right. And now, Mr. Yusuf, aside from the COVID-19 outbreak, a lot has happened in the macroeconomic space. We've had the GDP number, which of course came out quite positive, irrespective of the IMF's downgrading of the outlook. And then, of course, inflation numbers have continued to be on the rise. We have a trade deficit. So looking at all of these things, what would be the topmost factor that members would have to take into consideration at this meeting?
Well, I think the topmost factor will be what can actually further stabilize the economy at current levels. I think one of the most critical decisions that has been taken is what has been taken even before the MPC, which is the exchange rate adjustment. Of course, for us in the private sector, it's a very painful thing because this economy is highly import dependent. I also know that quite a number of the real sector players are also highly import dependent. A lot of our manufacturers are highly import dependent. So this is going to push up cost of production, definitely.
This is necessary.
It is necessary, it's inevitable. But these are some of the price that we have to pay for the long period of the structural defect that we have in this economy. But as things are, I think that we should just worry well about maybe the inflationary situation, because as it is, we are likely to see an upward trajectory as far as inflation is concerned. It's already high, it's likely to go high even more, because the core component of inflation, which is driven largely by the exchange rate development, is going to go up significantly. And of course, we have seen all the challenges with the supply chain disruption that has happened. That is also going to affect the supply side. It's also likely to push up inflation from the cost push side. So I think what we should be looking at is how we can moderate all of this to ensure that we don't see a further deterioration in the macroeconomic conditions. But as for the structural issues, as for the fundamental macroeconomic conditions, there's very little that we can do, because these things are driven by external factors. And of course, because we are very vulnerable, and we have to live with that for some time. I don't see what the CBN, for instance, can do about the pressure on reserves at this moment. Of course, the adjustment in the exchange rate will help a bit of that. I don't see how much you can do around infrastructure and all of that structural problem that we have. Although I noticed that part of the stimulus is about 1.5 trillion for infrastructure development, but that is not a quick fix. What we need at this time is something that can quickly, deal with the current situation. But I think it's just a question of stabilizing the environment as it is, so that we can move forward with the economy.
All right, Steve, do you think there are factors that the central bank may probably have to consider in their decision?
Well, that's the reason why the MPC is actually being held anyway. So, yes, there are factors they need to consider. I think they're going to reappraise for me, I think the MPs actually took place when they came out to announce the stimulus package. But this time around, they are going to sit with the bigger committee and probably ratify those decisions and look at other areas they actually can do or use to tinker with the volatility in the market and, at the same time, calm the nerves in the financial market sector down. I think prior on the list will probably be what I mentioned earlier. The banks have actually been under serious scrutiny and actually been bearing, as you may, I think they're the one bearing most of the brunt of this particular financial volatility. Looking at how much of CRR debits is being debited into their account every time, and how much they are under pressure to make sure that the LDR is actually being pushed out to the real sector. I think there should be some consideration in terms of regulatory forbearance on that. And probably they would tinker with CRR adjustment to see how much they can release to that sector too. But at the same time, I know the CBN would probably be worried about inflationary pressure. The adjustment they've done in terms of the exchange, I think is good. But again, I think we need to follow that or look at that market very critically, because I think there's still shortage of, in terms of supply of dollar. There's still a lot of investors who are on queue to actually get out, while we have few people who are actually willing to come in. That exchange rate adjustment, probably we might need to look at it again. I'm not too sure whether this point is actually the level it should be, but that's my personal opinion. Then again, looking at the oil price, which is the only where we have, if, 50% of our revenue is actually being generated from the oil receipt, then we have to look at that critically. Then looking at the financial space entirely, the equity market has been down by 17% year to date. That's over 3 trillion thereabouts being wiped off, from investors. We have to look at a lot of other issues. I'm not sure they're going to look at hiking rate at this point, because if you look at all the central bank around the world, everybody's tinkering with interest rate and actually lowering that. But again, I don't think they have room. So they might not be able to have that much of impact on the baseline effect. But again, they'll probably look at an orthodox method or way to address the financial institutions problem.
All right, now, okay, Mr. Yusuf, okay, you want to add something?
Very quickly, on the CRR, I've had complaints from the banking community about the fact that the CRR is supposed to be dynamic in nature. In other words, it's supposed to be a percentage of your deposits, so that as your deposits vary, the CRR components will vary. But what we have seen is that the thing is static. Once a CRR is pegged on a particular deposit, even if your deposit is going down, the thing remains static. So invariably, in practical terms, you see situations where CRR is about 30%, 40%, 45%. So I think we need to appeal to the CBN to ensure that we have this flexibility with the CRR. It should actually be a percentage of the prevailing deposit situation of each bank. It has to be flexible. It has to be a bit more dynamic, so that you don't put more pressure than necessary on the bank's liquidity. I think that is very important.
All right. Now, Matt, you have watched the Nigerian economy evolve over time. You have followed the macroeconomic data coming out of Nigeria. Now, aside from this COVID-19, for you, what do you think should be topmost factor for the central bank today, factor for consideration today?
So apart from COVID-19, so I think the stimulus of the economy overall, I think will be very important for the central bank when it's making its decision. So this country, Nigeria, is currently clearly facing a bit of a crisis, an economic crisis on its hands. And it probably will be considering that, or avoiding a crisis, or sort of softening the impact of the slowdown in global oil markets and the domestic economic slowdown. So I think stimulus of the economy is probably going to be one of the most significant factors it takes into account when it's making its decision today. And for this reason, I think a sort of cut is probably unlikely. An increase is probably unlikely. A cut is more likely to the rate. But the central bank will also take into account the fact that the naira, there is downward pressure on the naira. There's downward pressure on forex reserves, and this is really being exacerbated by the sharp decline in oil prices. So the central bank has to sort of, in my opinion, it's being tugged in two different directions. It wants to stimulate the economy, but it doesn't want to spook investors too much by cutting rates and sort of accelerating the outflow of foreign currency reserves from the country.
All right, just continue with that conversation. There's an update on the COVID-19. The Nigeria Center for Disease Control, NCDC, has confirmed 2 new cases of COVID-19 in the country, putting the total number of confirmed cases at 42. The NCDC says one of the cases is in Lagos State and the other in Ogun State. While one case is a returning traveler, the second case is said to be a contact of a previously confirmed case. A breakdown of the confirmed cases shows that Lagos now has 29, FCT 7, Ogun 3, and Ekiti, Oyo, and Edo have 1 case each. Okay, I'm just told that the central bank governor is ready to brief the press.
COVID-19 and the oil price war between Saudi Arabia and Russia. The committee assessed the development in the global and domestic environments during the first quarter of 2020 and the outlook for the rest of the year, including the threats to capital flows, growing vulnerabilities across global financial markets, the probability of a global recession, risk to price and financial stability, as well as the quick intervention by central banks to restore normalcy with guidance for further action. 10 members of the committee were in attendance at this meeting. The global economic developments. The committee noted with concern the combined demand and supply shocks to the global economy arising from the outbreak of COVID-19 and the oil price war between Saudi Arabia and Russia. It also noted the weakening performance of global output growth since January 2020, reflected in losses in global stock values, declining primary commodity prices, disruptions to the global supply chain associated with large-scale global lockdowns of mega metropoles and whole countries, and social distancing. Also, there has been adverse shocks to global capital flows, vulnerabilities and uncertainties in major financial markets, as well as rising corporate debt in the advanced economies and public debt in some emerging market and developing economies. Consequently, global output growth in 2020 is projected to fall significantly below the initially projected level of 3.3%. Inflation in the advanced economies continues to trend below long-run targets, except in the United States, especially in the light of prevailing headwinds and heightened uncertainties in the global economy. Central banks in the advanced economies have thus engaged in a coordinated approach with peers to embrace quantitative easing across every sector, notably in transportation, travel and tourism, health, and setting up of social safety net funds to stem the impact of these headwinds on aggregate demand and supply. In the emerging markets and developing economies, price developments remained mixed with upward inflationary pressure in some of the key economies. Domestic economic developments. Data from the National Bureau of Statistics showed that growth in real gross domestic product GDP continued to improve during the fourth quarter of 2019. Consequently, real GDP grew by 2.55% in the fourth quarter of 2019, compared with 2.28% and 2.38% in the preceding and corresponding quarters of 2019 and 2018, respectively. Growth during the fourth quarter of 2019 was driven largely by the strong performance of the oil sector, which grew by 6.36%, though lower than 6.49% recorded in the previous quarter, while the non-oil sector grew by 2.27%. The manufacturing and non-manufacturing purchasing managers' indices expanded, though at lower rate in February 2020, for the 35th and 34th consecutive months to 58.3 and 58.6 index points, respectively. Star projections indicate that real GDP during the first quarter of 2020 will slow because of the tepid global demand resulting from the recent outbreak of COVID-19, depressed global demand, and the oil price war, which has resulted in supply glut and decline in crude oil prices. This muted outlook for the first half of the year may thus dampen overall growth prospects for 2020. To mitigate this trend, the bank took decisive action to safeguard the Nigerian financial system and the economy from the emerging headwinds. The key policies include provision of extended moratorium on loans by an additional 1 year beginning from March 2020. This is to ease pressure on loan repayments. The bank also reduced interest rates from 9 to 5% on its existing intervention programs over the next year, created a 50 billion naira fund to support households and small and medium enterprises affected by COVID-19, introduced credit support for the healthcare sector, introduced regulatory forbearance to consider temporary and time-limited restructuring of loan terms and tenures to households and businesses affected by COVID-19, and strengthened the loan-to-deposit ratio policy. The bank also announced an intervention fund of about 1.1 trillion naira to cushion the adverse effects of the coronavirus outbreak on the economy. The sum of 1 trillion naira from this amount will be used to support local manufacturing, to boost import substitution, while the balance of 100 billion naira will be used to support the health services and products through the provision of loans to pharmaceutical companies, hospitals, and other health practitioners to build new hospitals and health facilities or expand existing ones to first-class health centers. This is in addition to the 1.5 trillion naira private sector-driven Infraco project fund designed to target the construction of critical infrastructure across the country. In addition, pharmaceutical companies will be assisted through loan interventions to re-establish drug manufacturing firms in Nigeria and curtail the spread of the coronavirus. In summary, it is expected that through these interventions, about 3.5 trillion naira will be created as stimulus to support the Nigerian economy during this trying time. The committee noted the continued uptick in headline inflation year on year for the 6th consecutive month to 12.2% in February 2020 from 12.13% in the previous month. The increase in inflation was largely attributed to increases in the food and core components, which rose to 14.9% and 9.43% in February 2020, from 14.85% and 9.35% in January 2020, respectively. This was driven by the shocks to food prices associated with renewed insurgency in major food-producing areas of the country and persistent infrastructural deficits. The MPC observed that broad money supply contracted for the 2nd consecutive month by 2.29% year-to-date in February 2020, reflecting the decline in net foreign assets and net domestic assets. Specifically, the contraction in M3 was driven primarily by a decline in securities other than shares and currency outside depository corporations in the review period. Net aggregate credit, however, grew by 1.34% in February 2020. Committee noted with satisfaction the growth in aggregate credit by 2.35 trillion since the inception of the loan-to-deposit ratio, reflecting the potency of the policy, and thus urged the management of the bank to sustain the current momentum of improved flow of credit to the private sector in Nigeria. It emphasized the need for coordination with the fiscal authorities to strengthen access to credit to some critical sectors of the economy, including the weak and vulnerable population, particularly those in the informal sector, through the setting up of a special fund, as well as support the enforcement of credit recovery. Accordingly, sectoral distribution of credit between end of May 2019 and February 2020 was as follows. Manufacturing sector, 533 billion. General retail and consumer loans, 380.7 billion. General commerce, 229.87 billion. Agriculture, forestry, and fishing, 163.04 billion. Information and communications, 163.69 billion. Finance and insurance, 131.2 billion. Construction, 112.25 billion. And transportation and storage, 45.42 billion, among others. The committee noted the dismal performance in the equities market as the all-share index decreased by 17.3% and market capitalization by 10.73% between end of December 2019 and March 2020. The decline was largely attributed to profit-taking and divestment by foreign portfolio investors, the delisting of shares of 3 quoted companies, and capital outflows associated with the COVID-19 and subdued global economic activity. The MPC noted the continued resilience of the banking system, evidenced by the further moderation in the ratio of non-performing loans from 6.59% in January to 6.54% in February 2020. Although the ratio remained above the prudential benchmark of 5%, the committee expressed confidence in the bank's regulatory regime and commitment to maintaining stability in the banking system. The outlook. The overall medium-term outlook for the global economy remains uncertain, with increased deterioration in financial market conditions and weak global output growth. The major headwinds to the current projection for global growth includes disruption to the global supply chain arising from coronavirus pandemic, oil price downturn as a result of subdued global demand, vulnerabilities in major financial markets, rising corporate debt in the advanced economies, and public debt in some emerging market and developing economies, as well as broad uncertainties leading to adverse shocks to foreign investment flows. On the domestic front, available data on key macroeconomic variables indicate the likelihood of subdued output growth for the Nigerian economy in 2020. Based on the current downtrend in oil prices, staff projections indicate that the output in 2020 will be less than earlier envisaged. The major downside risks to this outlook, however, include the continued spread of coronavirus, further decline in crude oil prices, and the reduction in accretion to external reserves, reduced government revenue, leading to a weak aggregate demand, declining non-oil receipts, as well as infrastructural and security challenges. These headwinds will, however, be partly mitigated by the timely and effective response of the monetary and fiscal authorities in containing the spread of COVID-19 viral infection, the recalibration and adjustment of the 2020 budget to the revised threshold while pegging expenditure to critical sectors of the economy, adoption of a new fiscal regime to encourage the buildup of fiscal buffers, sustained CBN interventions in selected sectors, enhanced flow of credit to the real sector, and deliberate policies to diversify the Nigerian economy. Committee's consideration. The committee reviewed the prevailing adverse conditions in the global economy, such as the coronavirus COVID-19 pandemic and the oil price shock, as well as the likelihood of continued oil price supply glut in the near future, focusing on the impact of these headwinds on the Nigerian economy. Committee observed that not only will the COVID-19 pandemic result in a health crisis, it will also result in massive economic crisis that will plunge many countries into recession, including the leading industrialized countries. The NPC took into cognizance the impact of the decline in oil prices on accretion to external reserves and the emergence of exchange rate pressures. Committee thus commended and endorsed the management of the bank for its prompt response with the adjustment of the exchange rate to uniform market rates and remove distortions. It, however, took note of the likely impact of the exchange rate adjustment on the economy. The committee noted the weakened revenue position of the federal government arising from the sharp drop in oil prices. It reiterated the need for government to urgently reduce reliance on oil revenue by gradually diversifying the economy and improving tax collection. To this end, MPC noted the speedy response of the federal government to the oil price shock by the revision of the 2020 budget downwards by 1.5 trillion naira and the oil price benchmark to $30 per barrel. However, MPC urged the National Assembly to avoid the tendency to increasing the benchmark price of oil in the federal budget, as this usually results in the adoption of unrealistic budgetary estimates. In addition, committee noted the introduction of price modulation, resulting in reduction in the pump price of PMS from 145 to 125 naira per liter, and its contributory effect in boosting aggregate demand, lowering inflation, and improving the wealth of the low income in the society. The MPC further noted the persistence of inflationary pressures attributed to a combination of monetary and structural factors, and thus urged the federal government to leverage on the public-private partnership, PPP, to intensify investments in infrastructure to increase output and employment. The committee cited the potentials for foreign direct investment flows to the Nigerian auto manufacturing, aviation, and rail industries, which could take advantage of these viable and untapped domestic and regional markets. The committee noted the sustained improvement in the financial soundness indicators, applauding the continued decline in the ratio of non-performing loans, growth in assets of the banking system, and profitability of the industry in the light of increasing global uncertainties. It also recognized the success of the bank's loan-to-deposit ratio policy and its potential to alleviate production shortfalls, reduce unemployment, and boost aggregate demand, urging the bank to pursue this and other related policies to a conclusive end. MPC underscored the coronavirus pandemic as a public health crisis, which will continue to undermine any monetary and fiscal stimulus unless appropriate measures are taken to test, isolate, curtail the spread, and treat infected persons while ensuring that migration across country is prohibited. The MPC therefore called on the federal government to take the necessary steps to safeguard the population through close monitoring and emergency-ready measures to identify and care for infected persons in the country, including compulsory restriction of movement to curtail spread of the pandemic. On the choices before the committee, MPC noted the recent actions of the bank targeted at strengthening the resilience of the financial system and alleviating the initial impact of the crisis. In its wisdom, committee felt that tightening will result in reining in the rising trend in inflation, and that it will support reserve accretion. However, it will reduce money supply and limit deposit money banks' credit creation capacity, thus resulting in increasing the cost of credit with adverse impact on output growth. Tightening would also result in a reduction in aggregate demand, as a fall in disposable income will result in output compression, whereas at this time, policy emphasis should be on stimulating aggregate supply and demand, both already weakened by COVID-19. With respect to loosening, whereas the committee felt it would stimulate the economy in the short term and boost aggregate supply and demand, the committee nevertheless was of the view that there was a need to be cautious in loosening, given the fact that it will exacerbate an already worsening inflationary condition, resulting in massive pressure on reserves and the exchange rate. Based on the balance of this argument, the MPC, in taking note of the recent actions already taken by the management of the bank in response to the COVID-19, resolved to allow time for the measures to permeate the economy while allowing the pandemic to wear out its plateau before deciding on further supporting policy measures to boost and strengthen aggregate demand and supply in the recovery phase of the economy. The choice to hold also considered the subsisting loan-to-deposit ratio and the DCRR policies, which sterilize excess liquidity in the banking system. Hence, an increase in the MPR would have been counterproductive. The monetary policy stance arrived at this meeting took cognizance of the need to address the unfolding unfavorable macroeconomic developments, reigning in inflation, support growth and employment through the extant interventions and recent initiatives, check capital outflows, and support external reserves creation, and dampen pressure and ensure foreign exchange market stability. A review of the policy options indicates relative tightness of the current monetary policy stance. The CRR was increased at the last MPC meeting. Time is required for its full effects to be manifest. Increasing the MPR will be contradictory to the recent reduction of interest rates in the CBN intervention programs from 9 to 5%. Besides, an increase in MPR will be taken by the deposit money banks as an invitation to increase lending rates, and this will be most undesirable at this point in time when efforts are being made to avert a recession. Besides, a reduction in MPR will not make the DMBs to reduce lending rates, but other strategies of the CBN are making the DMBs to reduce lending rates in furtherance of growth objective. Committee's decision. Committee noted the continued rise in domestic prices, the glut in oil supplies, and low oil prices in the wake of the current global shocks, exchange rate pressure, and other domestic monetary and fiscal responses to the evolving crisis. In view of the foregoing, the committee decided by a unanimous vote to retain monetary policy rate at 13.5% and to hold all other policy parameters constant. In summary, MPC voted 1, to retain the MPR at 13.5%, 2, retain the asymmetric corridor of plus 200 and minus 500 basis points around the MPR, 3, retain the CRR at 27.5%, and 4, retain the liquidity ratio at 30%. I thank you for your attention.
Thank you, Governor. Distinguished ladies and gentlemen, unfortunately, we will not be able to have the usual question and answer session on account of our efforts to ensure that we do not spread the coronavirus. You can see the social distancing platform of the MPC room. We want to tell you that we will take up your questions, send them to our Twitter handle, our Instagram page, or Facebook. We will provide answers and clarifications. Also during the week, we will endeavor to be on the various television platforms to provide explanations for the decision in case you want to know. Thank you so very much, and may God save our country from this pestilence.
Well, the governor of the central bank, Godwin Emefiele, of course, the Monetary Policy Committee retained all the monetary policy tools, left all the tools unchanged, with the CRR retaining at 27.5%. The MPR was retained at 13.5%. The asymmetric corridor of plus 200 and minus 500 basis points around the MPR, and of course, the liquidity ratio was maintained at 30%. Well, I still have here here in the studio my guests, Mr. Muda Yusuf, the Director General, Lagos Chamber of Commerce and Industry, and of course Steve Osho, Managing Partner at Commercial Partners. And I have there in London, Matthew Kiniga, a Senior Analyst for West African Markets at Docker Frontier. All right, gentlemen, let me get your views on what the central bank has arrived at. Mr. Yusuf, was that in line with your expectations?
Yes, it's in line with my expectation. Because before now, the CBN has taken quite a lot of actions, a lot of steps to address the prevailing challenges. So it's as if all this action has even preempted what the MPC will have done. So this is it's not coming to me as a surprise. This is what I actually expected, because we need to allow some of these policies, we need to allow time to see how they will impact the economy. What is just important is just to stress the need for other policies to complement what the CBN is doing. We haven't seen anything from the tax angle. When you have challenges like this, you can also adjust the tax policy to provide some stimulus, especially in a targeted way. We also need to see some, adjustment around trade policy. We have import duty challenges in some of these sectors. We should begin to look at all of these and see how we can tweak them to support the objective of this recovery and the objective of the stimulus. So we need to bring all the policy instruments on board, so that it's not just only the monetary policy that we'll be grappling with. Yeah.
All right, Steve, did that come to you as a surprise?
No, really, not at all.
Yeah, because a lot of people would be expecting the central bank to perhaps bring down the MPR, considering that all the other countries, I mean, even African countries, are bringing down their MPR.
But I mentioned that earlier. I think the baseline effect will actually not work at this time. The reason being the fact that Nigeria is actually at a very peculiar situation right now. So we have, exchange rate pressure. We have a lot of offshore investors who are willing, trying to actually get their capital, not more, interested in return on capital at this point in time. And we have reserve that is actually dwindling. We don't want to have too much of inflationary pressure. So, like I said earlier, it's not going to be any constitution for hiking. But again, it won't be in retrospect to what all the other CBN or central bank governors around the world is doing, because, like I said, inflationary pressure is there. That's number one. Number two, we're at a point where dropping rate now will actually, be counter-effective to some of those policies that have actually been, pushed across before now. Talking about the ADR, talking about the CRR, talking about how they want people to actually lend to the banks to actually lend to the real sector. And, the effect of that will actually hike the interest rate when you increase the MPR or probably reduce the MPR. So I think for now, the policy would be what they did a few days ago, and which I said this particular meeting was just to ratify and probably just assess the old policy trust that actually rolled out a few days ago and see how that plays out in the long run.
All right, Matt, you listened to Nigeria's central bank governor. Was that in line with your expectation?
So yes, broadly, I was expecting either for the interest rate to be held at where it is, the MPR to remain unchanged, or for there to be a small reduction. But the MPC noted that there is upward pressure on inflation and also increased accretion of forex reserves. So it really comes as no surprise that the MPC decided to hold the rate where it is. I thought it was really interesting to hear that they wanted to wait to see what the impact of their previous measures that they've introduced over the last month or so to help stimulate the economy. So, increased loans to the private sector, and also to see what the impact of the federal government's actions, both from a fiscal perspective, but also in terms of how they are responding to the coronavirus outbreak and the slump in global oil prices. So it really was quite a cautious approach, but probably quite well suited given that the situation in the economy, both domestically and globally, is moving quite rapidly. I do think we will see a potential change in stance later in the year, but at the moment, I think this wasn't a very surprising decision.
Now, for you, how should investors respond to the situation now?
So I think one thing that investors will consider will be continued access to credit. So the sorts of companies that we advise are companies that invest in local operations in Nigeria. They invest in local companies. And one of the concerns will be access to credit. So certainly this decision to hold rates at 13.5% won't necessarily contribute to improved access to credit in itself. However, investors will be monitoring the financial services or the banking sector and also overall levels of credit access in the economy. So this will be quite important for them in terms of investor sentiment. Investors will also be paying attention to what happens to the exchange rate and access to foreign currency reserves as well. So this decision today really kind of intertwines with those other factors, so access to credit and the exchange rate, what's happening to the Naira from the perspective of investors.
Mm. All right, Steve, how do you think investors can actually respond to this situation?
I think investors should, so there are two ways actually to look at it. We have to look at it from the fact that there's still a few exogenous factor that a lot of people will consider. And like you mentioned, I think most local investors will actually look at where the assets are being priced right now. We've seen a lot of assets actually being priced at a very cheap level. So there will be opportunity to say, let me look at some of these assets actually to invest in. But again, I think in terms of market liquidity will be very important. So people will assess market in fact that, okay, can we access this market and get liquidity at the point in time? So that's very critical. We've seen the Nigerian Stock Exchange actually said that they're closing the exchange and traders actually could trade from their different platforms. So I think how much of liquidity is seen and price discovery in that place will actually engender how much investors will actually play out. Then again, you have to look at offshore investors. So you have to look at other factors happening outside the country. So how are they reacting from the other markets? And that will actually signify how much of interest you're going to see in Nigerian space.
Now, talking about asset classes, how do you think this dimension can actually impact asset classes and investment inflow?
Well, for me, I think as an investor, I have to look at it from which area I'm actually looking at to invest. Am I looking at fixed income? Am I looking at equities? Am I a foreign direct investors? Which space do I think, based on the stimulus package that's been released by the CBN, where will the money go to? Which sector can I actually pitch now where I think there's opportunities? That's one angle. As FPI, I have to look at the assets, I have to look at the liquidity, I have to look at the exchange rate. Do I think at this point the price adjustment in terms of the exchange actually happened and the level that is right now is actually fair value? If that's the point, then I actually might need to look at some investors, some of the assets and say, I see opportunities here and it's the right time actually to come in.
All right, Mr. Yusuf, what do you think will be the implication of all of these for investors' confidence? Well,
first, let me say that this is primarily a public health problem. So where we go from here will depend on the extent to which we're able to deal with this containment problem. Gradually we are getting into a lockdown. Some states are already locking down. And as this situation progresses, we don't know how far we will go. So if you have a scenario of complete lockdown, that will dictate that investors generally will have to be very cautious to see how all of these things will play out. That is one. Secondly, this scenario is going to help in a way to address the issue of structural defects that we have in the economy. Because before now, we have seen a structure that was practically incentivizing imports and penalizing exports. But with this, although painful as it may be, it's going to make imports more expensive and exports, cheaper. So it will help in a way to turn around things. Secondly, it will also help to compel import substitution in a sustainable way, to compel companies, individuals to look more inwards, which is what we have been trying to achieve over time. Unfortunately, the foreign exchange regime before now has not been complementing that policy aspiration. Because it is one thing for you to aspire to look inwards. It's another thing for the policy, particularly the forest policy, to support it. But with the reality that we are faced with now, a lot of people, a lot of investors will now be compelled to look more inwards. So we are likely to see a scenario where industries that are more into backward integration are likely to emerge as winners in this scenario. They are likely to be more competitive than industries that are more heavily import dependent. So gradually, I think that will help the shift. And let me also emphasize the need for the central bank